Hey, everybody, this is Brian Bortz, one of the partners here at Cain Watters and also the chairman of the investment committee. I am joined today by Brad Sanders. Brad is the managing director of Tectonic, and this is your December month-end update as well as your 2022 year-end investment update. For the month of December, markets were pretty volatile again. The equity markets as measured by the S&P 500 were actually down 5.8%. Global markets, global stocks were down 3.8%. Domestic bonds were down about 0.5%, and global bonds were actually up 0.5% for the month of December. But that doesn't tell the story for 2022. As most of you that are watching this are aware, 2022 was a very, very volatile year. The S&P 500 was actually down 18.1%. Global stocks were actually down 18.4%. Domestic bonds were down 13%, and global bonds were down 16.3%. So as I talk to Brad here today, I want to convey the message that we had a really volatile year in the markets and in the economy. And when you look at this compared to other years over the last century, this was actually one of the 3 or 4 worst years in the stock market over the last century, and actually one of the worst, if not the worst, bond market over the last century that happened at the same time in the same year. Usually you don't get that. Usually you have a little bit of benefit from diversification. When the stock market's down, the bond market helps to mitigate some of those losses. 2022 was not so kind in that manner. That being said, our portfolios held up incredibly well, and we had dramatically less volatility than the markets. So, Brad, I'm going to throw it over to you and just see if we can talk a little bit about just what the heck happened during 22 and really kind of give our listeners an update and an outlook for 23.
Yeah, really kind of what most of our videos keyed on last year. 2022 was the Fed dramatically tightening interest rates to combat inflation. They made it very clear very early on in the year that they weren't worried about the stock market or the housing market or anything, that inflation was their number one priority. And I don't think a lot of people believe them. I think everybody should believe them now. I think that it's pretty interesting. For the last 10 years, you've had quantitative easing and easy money policy, and there's this don't fight the Fed and just everybody buy the same 5 stocks and the trend's your friend. And then now when everything's working in reverse, now everybody wants to fight the Fed, right? I just don't get that. I think the same mantra should hold true here. And really, that was the story of the year. We went from a zero lower bound on interest rates to a 10-year treasury in the high 3s to low 4s, depending on the day. And you had, basically everything got re-rated lower. Interestingly, in December, what caused some of the sell-off, we were expecting a moderately weak December to begin with, just because this is the first year in a long time where basically every asset class had losses. So you're going to have a lot of tax loss selling, a lot of rebalancing. A lot of books being cleared by the year end, where normally you have gains, so you don't really see a lot of that activity. But then the Fed came along right before the holiday break and said, hey, everybody, we're going to be tighter for longer. Really hawkish statement, basically saying, we're nowhere near loosening our policy. I know we just hiked rates 0.5%, but you can expect more hikes, probably more than what the market's priced in. And I think that's going to be the story for at least the first half of the year that's really going to drive markets. Markets right now, the Fed comes out, raises rates. Then when their statement comes out, the market jumps on everything they say. Then you get the CPI number, usually a week prior or a week after. And then the market jumps around and guesses what the Fed's going to do based on the CPI. And then about 2 weeks after that, the Fed always talks and kind of walks the market back. The market's wanting to price in all this future stuff, and the Fed kind of coming in and slamming the brakes on everybody. And I just think that's going to continue to be the narrative as we move into 2023. The Fed policy is lagging. The Fed's not going to cut rates the moment inflation gets to 3%. The Fed's going to sit and wait and see all that inflation numbers come in, and then start, moderating and easing policy later as all the effects of all their rate hikes that we haven't even felt the full effects of the first one yet, move their way through the economy. The Fed doesn't ever come in and just change policy direction momentarily based on one data point. And so there's a lag to this stuff. And I think the market's wanting to hurry up and speed it all up and trying to price everything in without having full visibility. And that's just going to contribute to an already volatile environment. We've got an environment where inflation's headed the right way, but we would expect it to not be linear and be bumpy. Economic data is softening. We expect housing to really, that housing data is everything we look at is softening. That's not going to really show up in the data till after this summer because of the long lag on a lot of that stuff. And so I think until we get to that point, the Fed's going to keep their foot on the pedal and continue to keep policy tight. And it may be in the back half of the year before the economy might force their hand to at least take their foot off the gas and to maybe start softening their stance. But until then, we're going to have data-driven moves in the market, and then the Fed trying to walk it all back after that. And it's just going to make it tremendously volatile like we saw in December.
Yeah, I mean, that makes a lot of sense, Brad. Let me summarize a little bit to make sure that I understand it as much as our listeners will as well, that what we're basically saying is 2022 was just a bad year. It was a bad year for stocks. It was a bad year for bonds. The Fed interjected a lot and really drove policy through that affected our economy. If I'm listening to this on the other end of this cast and I want to hear something about a prognostication, if you will, for 2023, what optimistic view do we have that we're looking into? And before you answer that, let me ask you this. You know, I see that there's a lot of parallels to this market and this economy to the 1990s. You and I are both fortunately old enough to remember the 90s. So if you could let everyone know kind of what our thoughts are on how this parallels the 90s, and then what that really means for the stock market and the bond market as we move forward.
Yeah, I've kind of alluded to the 99 to 2000 .com bubble a lot this year in all our newsletters and maybe some on these videos. I can't remember, but I'm sure I brought it up. What you have this time around, much like you had last time, was you had a small segment of the market that drove all the returns. Back then it was .com, and then you had the bubble, and all these companies changed their name to .com and their stocks would triple and all this stuff, and it was just nuts. But really, if you look underneath that market in 99, all the blue chip names, all the big cap, Home Depot was trading at a low single digit multiple because the narrative was, that stuff's over. The internet's going to replace everything and you don't need to own these stocks. And all that stuff was tremendously underinvested. And then people forget in 2000 and into the first 9 months of 2001, all those stocks, if you look at that group, were up 20%. Those value, what you would call value stocks, were up 20+% in 2000, while the NASDAQ was just getting taken out behind the woodshed. And then in 2001, they were up another 15 to 20% again before 9/11 and the recession hit. And I think one of the optimistic things we can look at is this market is set up the exact same way, where you could have not necessarily a headline banner year for equities. I'm not prognosticating that we're going to have where you're going to be like, oh, the S&P is up 15%. I think that would be kind of a pipe dream at this point. There's ways you can get there, but I don't see them. But that's just a headline number. If you're actively managed and you're investing towards value and you're paying attention, there's going to be parts of this market that have the opportunity to bifurcate, where the headline indices that are dominated by the small subsector of stocks that drove this last rally, much like in the .com days, are now have rolled over last year, and there's still going to be a big weight around the neck of that index, but there's going to be parts of that index and parts of the market that are already washed out, that are profitable, that can do well during an inflationary period, that can remain profitable and can see their multiples expand as maybe their earnings aren't hit as negatively as people have already priced into the stock. I really think that might happen in this year. It may take a while to materialize, but I think there's parts of the market that you could invest in now and look up at the end of the year and have made some money, even if the economy's soft and we're in a recession or not, and you have higher rates for longer and you have all this negativity. There's all these contraindicators. Generally, when people are the most negative, you're supposed to be buying. And right now, I can't even remember in my career, and I've been doing this well over 20 years now, I can't remember a time where people have been this negative. So that if you look at all the contraindicators, they're telling you to put your toe in now, but kind of every cell in your body is telling you to wait. And that's the whole behavioral thing that Hunter brings up all the time. So I think we're looking more towards all the opportunities that are out there. At the beginning of this last year, if you would have asked me what I thought was a good buy, I'd have scratched my head for about 5 minutes. It'd have been a really boring video. But now I can name you 10 things in rapid succession that I think you could invest in now and look up in 5 years and have made a lot of money. And so we're evaluating those. We think we're going to have the opportunity. Those are going to become actionable this year. Our portfolios might change quite a bit this year if things happen the way we think. But that's kind of the parallel to 2000. There is this small subsector of the market that's driven all the returns is now driving a lot of the losses. And it's kind of, we invested in a small cap value manager late last year. Their portfolios, every company's profitable. There's 35 companies. It's trading at a single digit multiple. That whole subsector of the market's tremendously underinvested. Everybody's sold all their small caps to go buy Tesla and FANG and all that the last couple of years. You could have like money leaving that sector and going into small cap value that could speed up all those returns too. Where normally you get that small cap value, first 3 years out of the trough does really well. It may only be a year and a half this time because there may be a lot of liquid money looking for it. So we want to make sure we're there early so we catch that. And the other thing, I really believe that the bond market's going to end up in the green this year. That's going to be a welcome relief from last year. It's going to take a while to materialize. I don't expect, to have big numbers to be showing clients for the first half of the year. I think the Fed is going to raise rates again probably this month, and we're going to have to, digest a lot of that. But if you look at, the 2-year treasuries yielding 4.3%, you can buy a portfolio of investment grade corporate bonds yielding darn near 6%. The value guys are already sniffing around it. We would be buyers of fixed income here. And I think the Fed, it's going to force capital back into that bond market because there's returns to be had there, even with an uncertain rate environment. And I think the market at large is going to see that in the back half of the year and start gobbling those up. And so that would be another positive I see for the year.
That's great, man. Thanks, Brad. I appreciate the clarity there. And, for our continual viewers on this broadcast, I want to say I apologize that the better looking partner, Hunter, wasn't here today, but I will do everything in my power to make sure that he's here next month. Look forward to seeing you guys at the end of January for our next update. Thank you.